When buying options, picking the correct strike and expiration date can be confusing. Let's walk through how to analyze a put stock option. I'm using Robinhood, but all brokers are going to have a trade options button. Click that, and you'll come to a screen with all the basic option information on it. You'll have the current price of the stock right here, usually in the middle. You'll be able to select calls or puts, whether you're buying or selling, and there'll be a drop down for the expiration date. The strike price here on the left is usually going to be in list form and will correspond to the price or the premium of the option here on the right. Now, both calls and puts work very similar. I have a separate video just like this one that covers calls. Today we're looking at puts, so we'll select the put option up here at the top. Now all the strikes above this market price of 112, all of these are in the money. And everything below this line, all of these are out of the money. Why do we call it that? When you buy a put, you have the right, but not the obligation, to purchase 100 shares at market value. Then sell them to the contract seller for the strike price. So if I had a put contract at the strike price of 115, this allows me to purchase 100 shares of AMD at the current market price of $112, then sell them to the contract writer or the seller of this contract for 115. I'll make $3 per share exercising this option, minus what it costs to buy this option, and I will have made money. I'm in the money. Now, if my strike price is $110, then it wouldn't make sense to exercise this option. There's no way I'm going to pay $112 market price per share just to turn around and sell them at the strike price of 110. I would lose money. So this contract is out of the money. Now, buying a put is always a bearish move. The whole idea is to either exercise the option, buy at market price, sell it at a higher strike price, or once the stock moves in price, sell the contract back to the market. So that's our first decision. We need a stock that we are bearish on. The next decision is the expiration date. If you are bearish on AMD, you probably already have a rough idea of time frame. Maybe you suspect earnings for the next quarter coming up are going to be low, or maybe the company is overvalued right now and you feel 6 weeks from now they're going to reset. Whatever that time frame is, that is your rough idea for expiration. For this demo, we're going to look at something around the 2 weeks. So this one right here, 13 days. Now you need to pick a strike. And the very first thing you need to consider is risk versus reward. The higher strikes, all of these, are going to have higher premiums and they're going to cost more to buy and they're going to have faster gains and losses. The lower strikes are going to cost less. Their premiums are lower and they have slower moving gains and losses. How much are the gains and losses? For that, we need to look at the Greeks. So let's say I'm very confident that AMD is going to decrease in value. I want to maximize my returns and I'm comfortable with spending more. I might look at this 119 option right here. If I click this row, I'll see the Greeks: delta, gamma, theta, vega, and rho. I did a whole video covering the Greeks in detail, so please go check that out. Now what we're going to focus on here is the delta. Delta tells us that this contract is expected or should gain or lose about 74 cents for every dollar that AMD changes in value. Remember, options are sold in blocks of 100 shares, so you need to multiply the 74 cents by 100. So I'm paying a lot up front to buy this contract, $720, but I'm also getting a lot of movement, $74 in gains or losses. Contrast this with a lower strike. Let's say I'm not real confident that the strike will move, and I might want to risk less money up front. Picking the 105 strike here, you can see that the delta is 15 cents. I'm going to pay a lot less for this option. This one you can buy for $75. And when the stock moves $1 up or down, I will gain or lose less, $15. And that also makes sense. Do we really think that AMD is going to close under 105 by expiration? Well, maybe, but there's a good chance that it won't, because looking at our expiration date, it only has 13 days to make that move. So there's a higher probability that this contract will expire out of the money and worthless. That's why it's cheaper to buy, and gains and losses won't move as much. Then, of course, I could pick something more in the middle. If I were to take a look at this 113, which is very close to market price right now, I'm going to pay $120 for this. And if I look at the delta on it, it's going to move 47 cents or $47 for every dollar that AMD moves. If we change the expiration date out further, say we pick something about a month out, March 14th, we're going to see that that same $105 strike that was $75 before is now going to cost more. We can see that it's now $158. And if we look at the delta on this, it's going to move $21 for every dollar that AMD moves up or down. And again, that also makes sense. Before, we only had 13 days for the stock to move. Now we've got 27 days. Now again, you don't have to hold these contracts to expiration date. At any time, if the contract has gained or lost value, and it doesn't matter if the contract is in the money or out of the money, you have the option to sell this contract back to the market. So we've picked our stock, we have our strike and expiration date. Let's take a more detailed look at the data. Optionstrat.com is the best way to view your options visually over time. I've done a whole video on OptionStrat because there are tons and tons of options for this website. It's very powerful. For this video, we're just going to cover the basics, and you can see that I have put AMD at the top here. And when I do that, it gives us the current price of $113. This is a long put, so I have our put that we had purchased at a strike of $112. And it shows us that it will cost us $268 to open up this option. I've picked February 28th as the expiration date. That's about 2 weeks from now. And then we come down here and we look at the graph, and this will show us exactly what is going to happen or what is supposed to happen to this contract over time. Buying a put is a bearish move. So when you buy a put, what you want is the stock to drop. And you can clearly see that the green down here is an increase in value in our option, and the red is a decrease in value in option. And so if we want to see what is going to happen to our option, say halfway through, let's pick February 21st, we can see that at close, if we want to be in the money, if we want our option to increase in value, then we're going to want to be, let's see, $69, $134. We're going to want AMD to be in the $110 to $109 range. So we're looking at for it to go down $3. By the time that this option expires on the 28th, for us to be in the money, we want it to be 109 or below. You can see that the max loss over here, $268, is anything that is above the 112 strike price. And that makes sense because our strike is 112 and anything that or above would be out of the money and would expire worthless. There's a range slider down through here. So if we want to see fewer values or if we want to see more values, this will show us exactly what's going to happen to the option at a particular time from now until when it expires. You can see that the more that it drops, say that AMD drops to $96, you can see at the time that it expires, it'll be worth $1,300 more than it is right now. Again, optionstrat.com has a lot of information and too much to cover in this video. This is just the basics. So if you have questions, please leave them in comments below or come check out our Discord. We have 100,000 members, completely free to join, and myself and many other experienced traders are in there every day helping people level up their trading game. Thank you for watching, and I hope to see you in the next video.